Hi, everyone. I'm Kieran O'Dwyer, Vice President of Corporate Communications at Mutual of America Financial Group. Thank you for joining our April Economic and Market Perspective webinar. Just a quick housekeeping note, you can access a PDF of this presentation and other related content through the paperclip icon in this webinar. Today's webinar focuses on inflation's continuing impact on the financial markets, economy, and consumers. Even as inflation continues to ease, Americans continue to feel its effect, whether looking at their retirement savings accounts, dealing with food and gas prices that remain high, or facing home mortgage interest rates that doubled in the past year. Over the past year, we've all read and seen how the U.S. Federal Reserve is continuing its attempt to cool the economy, reduce inflation, and avoid a recession. And we've also watched, and many have experienced firsthand while holding tight to the roller coaster bar, the highs and lows of the financial markets. As always, to help us make sense of it all with his expert insights and analysis, please welcome Stephen Rich, Chairman and CEO of Mutual of America Capital Management, LLC. Thanks for joining us again, Stephen.
Thanks, Kieran. It's great to be here again.
Stephen, as we've done in the past, let's start by looking at the financial markets. It's been quite a quarter we just finished up with. Inflation numbers have nearly been cut in half since their peak last June, but consumers continue to feel its impact. And yet, both the stock and bond markets performed well overall during the first quarter, after both suffered during most of 2022 before rallying at the end of the year. What's happening within and outside of the markets that's leading to these results?
Yes, Kieran, the equity markets did have a strong quarter, but it was a bit of a bumpy ride along the way. Markets are forward-looking, and they're trying to anticipate when the Federal Reserve will stop raising interest rates. The markets were volatile as a tug-of-war played out between investors, short-term data points, and policymakers' commentaries. As a result, the equity markets seesawed through the quarter. In January, there was hopes of a rate pause, which made markets rally. In February, there was data that indicated that the economy was stronger and the mantra was higher for longer. Then there was a reversal in March with some weak economic data and the banking turmoil, which led the market to rally on the premises that rates may be cut. In general, in the equity markets, it was a reversal from last year, 2022. The best performing market this year has been the NASDAQ, up over 17%, while the S&P has returned a more modest 7.5%. However, if you look at the S&P and you look at the largest companies in the index, you'll see that the top 50, also known as the Nifty 50, returned 11.6%, while the bottom 450 stocks returned only 2.3%. One of the standouts in both the S&P and the NASDAQ index was NVIDIA. NVIDIA is a chip maker whose products go into many artificial intelligence applications and has been an extremely strong performer. Once again, NVIDIA was one of the laggards last year. On the bond side, the bond market has been nothing but boring. Like equities, bond prices rose in the quarter and it followed a similar path. This was even as the Federal Reserve raised rates twice in the quarter, but Treasury yields declined at the same time. If you look at the Bloomberg Aggregate Index, which is up 3% in the quarter, this is a significant move. This would indicate on an annual basis that it would be close to a 12% return. These are heavy returns in the bond market. I'd also like to note that over the last 6 months, while the Fed has raised rates 4 times for a total of 175 basis points, the Treasury yield, the 10-year Treasury yield, actually rallied just under 5%. In fact, during the quarter, bonds have been more volatile than stocks. If you take, for example, the 2-year Treasury, which is tied to Fed fund expectations, it fluctuated by 20 basis points on 9 different days. The yield curve continues to be inverted. This means that short-term rates, such as Fed funds, have higher yields than longer-term rates. Bond investors are indicating that this is a possible sign of a recession, as this tends to be a precursor to a slowing of the economy. So with that, we've had a very volatile market, albeit markets have been positive and much of a reversal from 2022. But it's good to see the first quarter being logged in with some positive results.
Thanks for sharing that. I would think it's good. Certainly from people who are saving for retirement, obviously taking a long-term perspective is key, but those positive results are likely a relief for people with 401k and 403b accounts. I'd like to shift to focus on inflation for a little bit now. The U.S. is moving into its third year with inflation levels above the Federal Reserve's target rate of 2%. And just looking at the data, it clearly shows that inflation is easing, which seems encouraging enough. But run us through these government gauges to highlight what each is focused on, and then take a broader look at the CPI.
Sure, Kieran. Inflation does continue to cool from its peak. You can see the peak for inflation, at least measured by the CPI, was in June of 2020 at 9.1%. The most recent reading, it comes in at 5%. This is the lowest level in 2 years, but it's still above the Fed's 2% target rate. And the underlying price pressures are likely to keep the door open for the Fed to raise rates once again in May. So one of the things that I think is important to note here is what has caused inflation. If we go back to March of 2020 or even pre-pandemic, we can see that inflation rates as measured by the CPI were very much in the 2% sort of range. And from the period of March 2020, you can see that inflation has really risen considerably. And the primary driver really has been both the monetary and fiscal stimulus that the government injected into the economy to fight off the recession created by COVID. So as we work this down, this is really a result of all the spending that was done in a previous period. And now the Fed is on a mission to tighten monetary and fiscal stimulus to slow the economy. As we look at slide number 5, we can see the other 2 gauges which are looked at. But these are the 3 gauges that people triangulate to try to determine the path of interest rates. As we've discussed CPI currently stands at 5%. The next gauge that people look at is the producer price index, which has actually come down in recent periods and stands at 2.7%. This is the measure of inflation or costs that producers feel when they are making their goods. This would be something like raw materials, which in general have trended lower. And this can ultimately be a predictor of consumer prices to come in the future, but it can be more volatile. For example, the PPI in October stood at 8%. So this is a much more volatile gauge. Then we can also look at core PCE that stands at 4.6%. This is the gauge that the Fed likes to look at most consistently because it offers a broad range of spending by consumers. This number has seemed to be a little bit more sticky than the others, and the main component in there that has been harder to move down is shelter costs or rents, because these are very slow to change. But in general, all 3 of these measures have shown improvement. However, it's our opinion that they haven't shown enough improvement for the Fed to either pause or potentially lower rates in the near future.
Thanks for sharing that, Stephen. Appreciate the insight on government inflation gauges. As I noted at the start, over the past year, the Fed has taken aggressive steps to raise interest rates. And this past quarter, 2 rate hikes were smaller than most in 2022. Though these brought the Fed rate to 5% for the first time since 2007. Along the way, an unexpected banking crisis came into the picture. I'll ask you to talk about that in a few minutes. But for now, take us through the progress the Fed has made with interest rates and where they might go from here in the short term and looking ahead.
Right. The Federal Reserve is laser focused on bringing down inflation. And in order to combat inflation, they've aggressively raised interest rates. Since last year, March of 2022, the Federal Reserve has hiked rates 9 times for a total of 4.7% in terms of increases. They've done 2 additional increases this year of 25 basis points each. However, we have to remember that interest rate policy is a blunt tool with long lags and uneven, which was a blunt tool with long and uneven lags. Have been indications, however, that these increases have started to slow the economy. We've seen that in housing, we've seen it in IMS data. We've also seen GDP estimates start to slow later in the year, the economy. The Philly Fed survey has also shown some weakness. Most recently, retail sales have also come off from their highs. With all these things slowing, this sheds a very optimistic picture for the Fed in terms of their ability to lower inflation. However, we don't believe that there's been enough, and consensus is still calling for a 25 basis point increase in May. And we're also starting to see economists believe that this may be their last rate increase for a while, but we'll have to see how this all plays out over the next coming weeks and months.
You mentioned retail sales coming off their high. There are some other key areas affecting consumers that I touched on earlier, namely the spike in consumer mortgage rates, food and gas prices, which are keeping inflation levels elevated. What areas are consumers finding some relief, and where might some challenges remain?
So if we take a look at mortgage rates, there is no doubt that housing has meaningfully slowed. Home sales, construction of homes, and also the prices of houses have been falling. Mortgage rates have not been as high in over 2 decades. The situation that we find ourselves in is that owners are locked into their homes because the average existing mortgage for a home buyer or a homeowner is 3.5%. So it doesn't make sense at this point for an owner to sell their existing home with a mortgage of 3.5% and then buy another home with a mortgage of 7%. This phenomenon is called it's frozen housing transactions. Having housing transactions frozen will lead itself into the economy as a slowing mechanism over time. The next area where we've seen consumers feel the impact of inflation is in higher food costs. While these food costs remain elevated, these have actually come off the highs from where they were. These are basic products that affect everyday people every day. And as I said, they have begun to slow, but they still are elevated, and they are significant inputs into both headline CPI and also the CPE. Another area that people notice almost on a daily basis where inflation has hurt is in gas prices. You can see that gas prices, while they peaked in June of last year, they have come down, but still are running above levels that we've seen historically. Gas prices tend to be volatile as geopolitical actions can influence supply. Another reason that we believe that gasoline prices have actually improved over the balance of last year is that there was a release from the Strategic Petroleum Reserve. We've reduced that by almost 300 million barrels, which is a reduction of 37%. So this has given some aid to the gas prices, but gas prices remain a wild card in terms of their influence on inflation. And as I said before, these can be quite volatile.
Thanks for sharing those insights and their impact from a consumer perspective. Have we seen any slowdown in overall economic activity?
Yes, Karen, we actually have started to. And I point your attention to the next slide where we've seen that corporate earnings have started to slow. We can see that in Q4 of 2022, earnings were down 3.2%. During the first quarter, earnings are projected to be down 4.6%. Earnings have started to slow as cost pressures are starting to impact margins. Ultimately, this could lead to a growth recession as the economy cools. So this is another metric that we continue to look at, the health of companies and what their earnings look like. Looking at PE multiples is another way that we like to judge the valuation in the marketplace. If we look at the S&P's current valuation, it stands at 17.8%. Historic PE for the S&P has been 16.6%. So at the current time, it is our estimate that earnings, or I should say, price to earnings ratio of the S&P 500 is running a little bit above where it does historically, which would lead us to be somewhat cautious as we move through the balance of the year with the potential of slowing earnings and perhaps leading to a slower economy and even a recession.
Amid all of these changes, seemingly out of nowhere, some important regional banks failed last month. And for a brief moment, there were worries in some circles that a larger financial crisis might occur. Fortunately, it appears mostly contained to the banking industry, but it did add a layer of complexity to the battle against inflation. Would you take us through this, including why the financial markets, for the most part, appeared to shrug off the crisis?
Yes, Karen, it was a surprise to see three banks fail earlier this past month. But I would like to emphasize to everybody that it's our belief that the overall banking system is much healthier than it was in 2008 and 2009. The banks that failed basically mismanaged their asset and liability profiles. In all cases, we believe this was somewhat of a management issue, and ultimately there was a run on their assets, which they were not able to cover with their liabilities. There will be some immediate consequences to these failures. Number one, there will be more regulation. Number two, lending standards will continue to tighten, and there will be less access to capital. In fact, the 2 weeks ending March, lending activity dropped by over $105 billion. Ironically, these failures will help to slow the economy by doing some of the Fed's work, because there will be less lending activity, which will lead to less economic activity as we go forward.
Now, I know there will be continued focus on the banking sector and how that might affect how the Fed acts in the coming months. But shifting gears, the rise in interest rates is also having a negative impact on U.S. companies, as well as the U.S. government, in terms of borrowing and paying down debt from huge programs in recent years. The numbers, as we'll see in a minute, are staggering, and projections look daunting. But how might these issues be managed?
Yeah, Karen, that's a great question. One of the effects that higher rates will have, it will be on the ability of companies as well as governments to finance their needs. And as we've talked about before, the massive fiscal programs that have ignited inflation and taken our debt up to $31 trillion is really a result of those programs to combat the recession created by COVID-19. There are some unintended consequences to having significant debt. As we look at the U.S. government, approximately $7 trillion of this matures every year and needs to be reissued, and in this case, at higher rates. And so what we're seeing are the cost to service our debt are going significantly higher. If we look at those costs to service the debt in 2021, $352 billion. Last year, those payments went up to 475. And with rates where they are today, we project that the interest costs will rise to $640 billion. So as I said before, once again, this is an unintended consequence of the Fed raising rates so aggressively over the last year that the cost to service our own debt is starting to become significant.
Thanks, Stephen. Over the past couple of years, and even as the Fed took aggressive actions in the last year, unemployment rates in the US remain at near historic lows, and the job market and employee wages have been consistently strong. Can the labor market slow down enough to ease inflation without leading to a significant spike in jobs being lost?
Yes, the employment picture has been a real thorn in the Fed's side because it's not seen an uptick in unemployment, which would drive inflation lower. Key metrics in employment have started to improve, but certainly not enough, or not enough that the Fed feels that they've been able to combat inflation in the ways that they want. Looking at some of the data, if we go to March, there were 236,000 jobs created. This is versus a 12-month average of 342. While that's lower, 236 jobs in the month would still be a quite strong number. Another area or metric that we continue to look at is hourly earnings. Once again, they have moderated from the end of the year at 4.6 to 4.2. However, that's still considerably high as it relates to readings of inflation. Another metric we look at are the number of job openings. While the number has finally slipped below the 10 million mark, a mark that we have not seen since 2021, however, there are still many, many more jobs available than people are looking for them, which creates a tight labor market. As we can see from this chart, overall employment remains at historic lows, currently at 3.5%. Once we believe, or once the economy begins to cool, as we would predict, we do believe that unemployment should trend higher. However, to date, we have not seen this trend. And as I said earlier, this remains one of the most puzzling things to both the market and also to the Federal Reserve.
You've covered a lot of ground in a short period of time, Stephen, and we appreciate all your insights, especially as individuals try to make sense of what's happening in the financial markets and with the economy, and how these issues are affecting their savings and spending. With all of that in mind, what should individuals be on the watch for in the coming months?
Yeah, there are a couple key things that I think bear noticing in the economy. Number one, the Fed is laser focused on bringing down inflation, which leads us to believe that they will continue to be diligent about rates and keeping rates high enough to combat inflation. The Fed is essentially trying to thread a needle here by lowering inflation and not causing a recession. They're looking to engineer a soft landing. That being said, we believe that volatility will continue in the markets, in both the equity and the fixed income markets, as short-term data will affect investor behavior. We would also expect that the economy will slow, unemployment will tick up, and earnings will continue to be revised down. But the million-dollar question is, by how much? How deep and how long will the slowdown be? Or will there be a recession? And once again, how long and how deep? So as we move through the balance of the year, these are all things that we continue to be very focused on. From an investor standpoint, and one that's saving for retirement, this is always a good time to remember to be long-term focused and not try to time the market. Be sure your portfolio is diversified and appropriate for time horizon and risk tolerance. Remember, retirement savings is a marathon, not a sprint.
Thanks again for walking us through this complex yet important topic, Stephen. We really appreciate it.
Happy to be here, Karen, and looking forward to our next conversation.
Thanks. And as always, thanks to our planned sponsor clients and everyone else who attended this presentation. We really appreciate you taking the time to join us today. Before you leave, please take 1 minute to complete a brief survey and let us know about topics and issues you might like to hear more about in the future. This webinar will be available at mutualamerica.com to watch at your convenience. And as I mentioned at the start, you can access a PDF of this presentation and other related content through the paperclip icon. This concludes our webinar. We look forward to seeing you again soon, and thanks again and have a great day.